Hey guys, today I'm going to be discussing a little bit on some cap rate examples, so stay tuned. Alright guys, so first off, remember in a video I've talked about what is a cap rate. So a cap rate is your net operating income on, and this is typically for multifamily apartment buildings, okay? So this is what this is mainly for, like a big 100 unit or anyways, a 5 units plus type of building. They use cap rates to kind of know, like in the market, what investors are willing to pay, what type of return they're willing to pay for a property. So the lower the cap rate, the more the investor's like, hey, this is a great area and we're willing to have a little bit less of return, a little more risk to buy it because we think it's a less risky of an investment. So cap rate is your net operating income. As we know, net operating income is your income on the property minus the expenses you have on the property. That's your net operating income. Okay, and this is before paying a mortgage, paying the debt service on that property. And it is for the operational expenses, no capital expenditures. So a cap rate is the net operating income divided by the value of the property, okay? So if, first say you had $10,000 in net operating income divided by $100,000 value of the property, divided by $100,000, that would be a 10 cap, okay? 10% cap rate. As that's just what it is in the air. So depending on the rates and all that, usually what you'll see is, depending on the asset class of the apartment complex, A, B, or C. A would be like nice, high class, higher paid, low crime, kind of newer builds, depending on your markets. But in Memphis, Tennessee, where we're at, you're seeing anywhere to a 4 to 5% on these. You're seeing a 5 to 6.5% cap rate in the B class, and you're seeing a 6.5, I mean up to 10 in Memphis. I mean, really, actually, let's kind of trim down to 9. Not too much is above a 10, unless it's like super not occupied and stuff like that. Anyways, that's kind of in Memphis. Obviously, like you can use data sources like CoStar, and also talking to brokers that have sold dozens of properties in Memphis and other people, and kind of know what the going cap rate is in the area. Okay, on ours, we're buying kind of C-class properties. We're actually estimating ours around we've had appraisals, and the appraiser used anywhere from like a 6.5 to a 7.25, just depending on the area. So kind of we use a 6.75 for our C-class assets. But what is pretty awesome about just these cap rate examples, obviously, you know, maybe the D would probably be like an 8 to a 10. And then these adjust over time as the market changes. Back in 2012, you probably could have added plus 1 or 2% to all of these. So back in the market, right, in 2012, the bottom of the market, people weren't paying as quite as low of cap rates. So kind of not intuitive here is that you would think as the cap rate's lower, you think it's not a good deal, but actually that means like as the cap rate's lower, it means like you can sell it for a higher value. So let me explain. So at a 5 cap, okay, let's say you had a subject property in an A-class neighborhood, okay, so the going cap rate was 5%, and you were able to raise rents by $1,000, okay, so going from $10,000 to $11,000, and you were able to raise rents by $1,000, okay, and you still had the same expenses. You could divide that by 0.05, which is the cap rate, and that would show you effectively how much value you've increased on the property. And it's a 1 to 20 ratio. Okay, so you would increase that value by $20,000. So if you had, you know, just a few units, you raise each one $5 here or there, it really increases the cap rate. For example's sake, let's say you just raise rents on all of your properties, and let's call it a 10-unit apartment complex. You raised it by $5. Now here's what's awesome. This is your annual. So $5 monthly times 12, and you had 10 units in there, you increased it by $600, okay? And if it was at a 5 cap, times it by 20, you're going to increase that value by 12,000. So sounds like okay, but that's on a 10 unit. Imagine if you could do that on a 100 unit complex. Okay? Yeah, 120,000. So it starts getting pretty dang awesome the bigger this is. One little sway and it goes up. Also one little sway the other way, it can go down in value quite a bit. Okay, so that's at a 5 cap. Just kind of showing you a different example. Let's say instead you had a property in a 10 cap and you were able to raise rents by $1,000. Okay, instead of increasing the value 20,000, you're only increasing the value by 10,000. Because you increase the NOI by the cap rate divided by the cap rate, you only get a $10,000 increase in the value on that property. Hope that makes sense. It's really awesome though, just showing like the lower the cap rate, kind of the better, because you can have higher swings. Now, there's also pros and cons to that. In the higher the cap rate areas, those are super competitive and people are going to typically overpay for that. Higher competitiveness. So there's a balance between A, B, and C class and the cap rates. And also maybe you can, maybe this one's like already maxed out quite a bit. You probably can't raise rents as much. You can maybe only raise rents $500 in this A class because rent's already maxed out. Where in a C class, you can raise rents double and therefore effectively get the same type of return there depending on what you're increasing. So it's just giving you some examples of how people play around with cap rates, how it really affects the market and everything like that. It's based on just what investors are paying and buying apartments at, and it adjusts as the market adjusts. Thank you so much for watching. Let me know, subscribe to this YouTube channel. Let me know if you have any questions or comments. Be happy to answer them for you. Thank you so much.